It's no fun looking at the account values of your investment accounts these days. In this week's Fastest 4 Minutes in Finance, some perspective for the pain. Hello again, I'm Scott Inman. As the second half of the year gets into full swing this week, we are all hoping things go better in the stock and bond markets than they did in the first half of the year. Our reaction to double-digit losses to our portfolio might be that we are entering a prolonged time of poor economic conditions and that things might get worse. And they might. Certainly, inflation and higher interest rates are headwinds for economic growth. But in this week's Fastest 4 Minutes in Finance, we make a case that we could simply be returning to reality. At the time of this recording, the S&P 500 index is roughly at the same value it was in March of 2021. That was 1 year after the economic shutdown imposed by our government in response to the COVID-19 pandemic. And it's still up, the S&P is, about 15% from the pre-pandemic level in February of 2020. In between, the government would send trillions of dollars several times to Americans. Many who needed it because they couldn't work, but many were working, meaning they got a raise. Our friend Brian Wesbury, the chief economist at First Trust Advisors, puts it this way. He says, quote, handing out too many government checks allowed American consumers to borrow from future production and spend more in the past 2 years than they would have if no pandemic had ever occurred. You could make a case that all the extra dollars in the economy created an artificial demand at a time when companies were also struggling to produce goods because of the pandemic. That got the supply chain kinked like a garden hose, and we are still trying to unkink it. That is a large contributor to the record inflation we are now experiencing. The Fed has responded by raising interest rates, which makes it more difficult to borrow for both consumers and businesses. The intent is to slow down demand. As those stimulus dollars are spent, we are seeing less demand in some sectors of the economy, which has investors spooked about a recession. And that is likely coming at some point. The Atlanta Federal Reserve's GDP model is projecting that real GDP declined at 2.1% in the second quarter. If that's true, we have met the traditional criteria for a recession. But our economic numbers may simply be returning to pre-pandemic levels. Unemployment is 3.6%, very close to where it was before COVID. Manufacturing production is 3.8% higher than where it was pre-COVID. You could argue that our response to the pandemic created a massive shockwave that is still reverberating, but could be about to end. So what's the takeaway for investors? Mohamed A. El-Erian is the chief economic advisor at Allianz. He writes that for long-term investors, it will prove beneficial over time that markets are exiting an artificial regime that was maintained for far too long by the Fed and that resulted in frothy valuations, relative price distortions, resource misallocations, and investors losing sight of corporate and sovereign fundamentals. The promise now is one of a more sustainable destination. Translation: sticking to your plan and betting on the U.S. economy long term is still the best path forward. Thanks for listening.